Robschild. No investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Thursday, March 20th, 2025. Today's episode comes out with the headline, Leading Economic Index, the LEI of the US, finds a lower low. All week I was saying this would come out on Friday, but no, it came out today on Thursday. Not sure why I made that mistake. The Market Watch calendar does make mistakes sometimes, so I'm thinking maybe that's why. Anyway, the Conference Board Leading Economic Index, this is from their own website, conference-board.org. The LEI for the US fell further in February. This is a major leading economic indicator, and it's well defined here at Trading Economics. You can see that what it does is that it has a predictive variable that anticipates or leads turning points in the business cycle by about 7 months. So when this turns to the downside, the expectation is that the economy will soon follow within 7 months. You can pause the video or go to the website yourself to read the full definition here. Let me scroll that in for you. So pause the video to read it yourself. The main highlights with this is that the LEI declined by 0.3%, so negative 0.3% to 101.1. Remember that number. The chart I usually use, Trading Economics, is not working well, so I'm using CEIC data. This is not updated for February. You can see that the lowest low that we had previously in the leading economic index was 101.4, and now we're at 101.1. That's why the title says a lower low. I have been saying for the past several months that the leading economic index has paused. It has gone flat. Yet February has now shown a lower low. This is a significant update for me. It adds for me to the bear case. It adds to the case that yes, actually the storm is actually really here right in front of us, even though we're not exactly in it yet. And we can see this shown very clearly in the next chart from the Conference Board's website themselves. The blue line is the LEI. That's the report we're talking about here. This blue line, when it goes down a lot, it pretty much follows the black line follows it soon after. And when the black line goes down, that's like we are definitely in a recession when this is really dropping. Now, very notably, as I've mentioned many times before, we peaked in 2022, and we've been falling for a long time now. It's 2025, guys. It's March of 2025. And yet this black line here, the coincident economic index, this is like the actual right now data as far as what's going on with the economy. It hasn't followed. It hasn't turned over yet. And I said, with this blue line bottoming here, are we avoiding the eventual, downturn of the black line? Is this going to kick back up? And no, we have a lower low this month. I was very curious to see what would be going on from here, if we would start seeing higher lows, higher highs, that kind of a pattern where the leading index is like, actually, this looks like we actually might be going towards a soft landing. I don't see that anymore. So watch out there, guys. I also I had to update the daily reminders. I'll get to that when we get there. The next main agenda item is the Fed funds versus the U.S. Treasury yield curve. I've been mentioning this on several shows. I want to point out one particular part of the Treasury yield curve, and that's the 2-year and the 3-year. I point these out only because they are the lowest on the curve, and they're currently basically right between 3.9 and 4%. While many people focus really mostly on the 10-year, and the Fed funds rate really, more than anything, the 2-year and the 3-year are telling a story here. They're saying that we expect the Fed funds rate to be lower than both of these yields. Market participants are paying more money for a lower yield that will expire in 2 and 3 years from now. And in order for the yield curve to get back to normal, the front end over here, it needs to drop below these numbers here. Now, the divergence I'm seeing is in the Fed funds futures. We can see that we have priced in the Fed funds rate to really be the terminal rate target between 350 and 375. This is only like a hair lower than what the 2-year and the 3-year are paying right now. So the 2-year and the 3-year bonds, or I guess they're notes, Treasury notes, are screaming that no, we know that the rates are actually going to go lower within 2 and 3 years from now. Of course, all of these numbers do need to be taken with a grain of salt. First of all, the Fed funds futures changes on a daily basis, and the further out you go, the less of a chance there is that that number will actually be the number by the time we get there. Same within the bond market. And the bond market, the 2 and 3 year note yields are further out, they're longer dated than the Fed funds futures contracts. Yet the bond market I see as a little more intelligent, and the 2 and 3 years are suggesting to me that there will be more cuts sooner than what the Fed funds futures are currently showing. Next agenda item. I am still long GDXD, if anyone was wondering, with just a tiny, tiny bit of my portfolio. With gold getting sort of into mainstream news, becoming popular, that's a big sign to me that, we might be at a top. Plus the technical chart pattern, it just tells me that there's a high enough of a probability for me to go short here with a very small amount of my portfolio. I will keep the community updated when I exit the short, and I expect it to be when gold drops around to the 2930 area. Moving on to the community topics, I want to hear from the community, what's your largest position right now, investment-wise? I'm very curious to hear what my viewers are currently invested in. As you know, if you're following the show, I personally am about 70% in long duration treasury bonds. So what's your largest position? Coming up next week, Thursday, we have Q3 GDP, the second revision. Weak or negative revisions can be foretelling of weakness. Not the hugest thing. The bigger report really as far as GDP goes is Q1 of this year. The preliminary data suggests that we are in contraction already. But this is still an important update to take a look at. We also have next week, Friday, the PCE favorite inflation gauge of the Federal Reserve, the personal consumption expenditures. As always, thank you so much for watching. Thank you for subscribing. I'm almost to 1,000 subscribers. The community here has been great. Thank you also for all the support. That's also been wonderful. I've been able to use the support money that I've been getting to update and upgrade the channel. Thank you so much. A few alterations to the daily reminders, notably, I had before for a while leading indicators pausing. I added a question mark, and now we're going to get rid of pausing, and I'm going to change it to still following, last updated for February of 2025. A few days ago, I mentioned sector performance, energy sort of outperforming a lot of other sectors. It's been one of the best performing sectors for quite a while now, and as it continues to outperform, it kind of suggests the closer and closer we are to a major economic slowdown, like a recession or a depression. Other than that, to hear me explain the rest of these daily reminders, watch Macro Update to 1125. and watch Portfolio Update to 1125 to hear me explain my crystal ball ratings and my portfolio. Extreme fear mode, says CNN Business Fear and Greed Index still. SPX, the S&P 500, starting to look really nothing more than a bounce. Call it a dead cat bounce, call it a bear flag, call it whatever you want. This does not look strong here. Not yet. Add to that the VIX, the fear index that measures the prices of options contracts, did drop a little bit today, 0.5%, below $20 to $19.79. If the fear was really out of the market, we would see this dropping further. I'd be less bearish on the S&P 500 if we had a larger move to the downside in the VIX. Next, I want to bring up the 10-year Treasury note yield. After breaking out of this little bear flag here, we dropped more today. Throughout the day, granted, yields rose back up, but not enough to look bullish by any means. If anything, I would see this as profit taking. After all, this blue line here is the 500-day moving average, which we touched exactly today. This overall pattern setup suggests to me that there is more downside in the 10-year Treasury note yield moving forward. KWEB, my favorite ETF of China, dropped by 3.6%. This was unexpected for me. I thought we had a bull flag building here. We had a big drop in Chinese equities today. And this coincided with a pause, finally, in Dr. Copper. While Dr. Copper seemed like he was gaining momentum like a rocket ship up to the moon. Like, how expensive can you get, Dr. Copper? We finally have a pause here with a doji candle here, which can represent a top. When you're at the top of a long period, which we are, and you get a doji like this, this is very frequently the marker of the top. And so I would not be surprised to see copper roll over here just from a technical chart reading standpoint. I've been talking about EWZ, Brazilian stock ETF, breaking out of this inverse head and shoulders pattern, testing it perfectly today. I love it when I draw a line the day before and the market just sits there. Like, I'm not the only one seeing this. That's very obvious to me. With this retest of the neckline, this is, in my opinion, an excellent place to come into Brazilian equities from a technical standpoint. The target, if this plays out in the near term, should be around $31, just a hair below. Last chart of the day, junk bond credit spreads. I mentioned yesterday how HYG went way up, and I thought that that would be represented in today's high yield bond spread because this is 1 day old, but we didn't. We're still flat here. Again, the HYG is a managed fund, and so the way those are going to perform is different than the bigger picture. The bigger picture you can see on the FRED, Bank of America U.S. High Yield Index, option adjusted spread. So I was thinking that today's reading would be way down here, but we are just flat here. So I don't know what's going to move forward. I just wanted to mention it. Overall, again, like the title says, the main thing on my mind is that the LEI found a lower low. This is very foreboding for the U.S. Oh, my goodness. Drakmar. Yes, I know. It's upsetting. Why do you think I have so many treasury bonds? But what do I know? I'm just a guy with a crystal ball, and that's all from me and my crystal ball. Hope you enjoyed Thank you for watching, and see you next time. Rob's Child.